This is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you the market insights for Wednesday, December 23rd. Over Christmas, the only major indicator that comes out is Japan's CPI. That's a crucial indicator for the yen because the Bank of Japan has pledged to keep its quantitative and qualitative easing program, QQE program, in place until inflation gets back up to 2%, which it says will occur sometime between October of 2016 and March 2017. However, a lot of people have their doubts. So there are two questions then. One, will they hit the target? And two, if they don't, what will they do? So far, it seems unlikely that they'll hit the target. In fact, they pushed it out 3 times already. But still, core CPI, excluding energy, their target variable, is only rising at a 1.2% year-on-year pace. Now, the Bank of Japan apparently believes that inflation will start to rise gradually as the effect of lower oil prices start to fade. This is a common theme that we hear from most central banks nowadays. But the big hope for the Bank of Japan and the Abe administration is that wages should continue to rise and that companies would pass these higher wages on into higher prices. That would be true inflation, not just yen depreciation pushing up prices. In fact, the relationship between inflation and unemployment, known as the Phillips curve, has become much closer in recent years in Japan as the country's working population shrinks and companies have to pay higher wages to attract workers. Now, services account for about half of the CPI basket, and the price of services is largely determined by wages. So if wages rise, then it should have a powerful effect on the overall CPI. But despite these optimistic signs, people are beginning to lose hope. Inflation expectations are falling again, as is the percentage of people who expect prices to be higher a year from now. So what if they can't meet the target? Then they have 3 choices, basically. 1, they can delay again the time when they expect to hit it. 2, they can increase their QQE program or change it in some way. Or 3, they can change the target. Now, I think a 4th delay on pushing out their expected time to hit the target would just be too embarrassing. That's why I expect they'll ramp up their QQE program. I think they'll have to move to more radical measures, probably by lowering interest rates into negative territory, as several European central banks have done recently. That should have a dramatic impact on the yen, as negative rates appear to have a more direct effect on the currency than a bond buying operation does. The other thing they can do, though, is to change the target. They're already tinkering with the composition of the CPI. Meanwhile, Economics Minister Akira Amari recently said that, quote, if consumer prices were rising more than 1.5%, then I don't think you could complain when talking about the price target, unquote. This may be the beginning of a campaign to redefine what inflation and deflation are. In any event, unless and until inflation does start to pick up in Japan, I think the market will expect further easing from the Bank of Japan, and that's likely to keep a downward bias to the yen. I expect to see the yen gradually weaken unless there's some progress on the inflation front. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.